CVS Health Corporation, ticker CVS, is currently trading at $55.42, and over the past month or so, the company has dropped by almost 25%. Now in this video, I want to have a look at the reason for this drop and evaluate whether the company is a good buy at its current trading price using my stock valuation spreadsheets. And in my stock valuation spreadsheets, using the 9-pillar analysis and the Graham's formula revised, the discounting cash flow model, multiples valuation model, and the dividend discount model, we will calculate the intrinsic value of CVS. Now to jump straight into it and understand why CVS has dropped by almost 25% over the past month, we will jump to the monthly full. Now the total revenue rose by 3.7% to 88.4 billion. And the revenue from CVS's pharmacy and consumer wellness segment rose by almost 3% to 28.7 billion. Now the first issue we come to is that the revenue in the health services, which includes CVS's pharmacy benefit manager, slipped by almost 10%, which is a larger slip than these two combined. Now turning to the largest problem CVS is currently having, we have a look at the healthcare benefits segment, where the revenue rose by almost 25% to 32.2 billion, but the costs soared much faster due to the increased Medicare utilization and the decline in the company's Medicare Advantage star rating, which basically dropped the earnings per share from $2.20 in Q1 of 2023 to only $1.31 in the Q1 of 2024, which is almost a 40-cent difference from what analysts have estimated. This is certainly not a valid reason for the company to drop by 25%, but let's jump over to my stock valuation spreadsheets and calculate the intrinsic value of the company. Now jumping to the stock screen, I already have plugged in the ticker CVS and all the metrics have shown up automatically. Just a reminder, if you do like these spreadsheets, you can access them at my Patreon at the link in the description. Now getting into the evaluation, we can see that the total assets, total liabilities, and total equity all rose, the total equity rising by almost 7% year over year. Now the current dividend yield of CVS is sitting at 4.8% with a dividend payout of $2.66 per share per year and a trailing payout ratio of 53%, which is slightly higher than what I like to see at 50%. Now the analyst's target price is currently sitting at $78, and the beta of the company is sitting at 0.56, which means that the company is quite more volatile than the S&P 500. Now moving to the 9-pillar analysis, we can actually see that almost all the fields are in the green except the net income growth over the past 5 years. Now looking at the 5-year PE ratio, which is currently sitting at 16, and the price to free cash flow currently sitting at 5.5, we can see that the company has been doing great over the past 5 years. Now we can see that the revenue growth is sitting at 13.33% per year over the past 5 years, and the free cash flow has been growing by about 12% year over year over the past 5 years. Now scrolling down to the financials and having a look at the net income, we can see that the reason for why the net income shows negative is this very large growth actually from 2018 to 2019. You always have to check for this when using these sheets, as the mathematics don't really work when you have a negative going to positive with the percentages. So we can see that there is actually growth in the net income by about 12% as well over the past 5 years year over year. Now scrolling back up, we can see that the long-term liabilities over the 5-year free cash flow negative dividends is sitting at almost 2, which means that the company can pay off most of their long-term liabilities with their free cash flow within the next 10 years, which is great. The consecutive dividend growth of CVS is sitting at 6.55%, and there are decreasing shares outstanding sitting at about 0.20% per year, which means that over the years you will own a larger percentage of the company. Now jumping to the first valuation model, the Grams formula, we take the earnings per share base PE sitting at 7, 5-year growth estimate, the growth rate multiplier sitting at 1.5, the average yield on AA Corporation bonds, and divide by the current yield on AA Corporation bonds. And doing this, we get an intrinsic value of $92.93, which is 40% higher than the current trading price of the company. And moving to our second valuation model, which is the discounted cash flow model, we take the free cash flow over the past 10 years or so and calculate the average growth rate to be sitting at 9%. The analysts do project a growth rate of almost 5%, and I do think that CVS has a good chance to grow about 6% per year over the next few years. So when I plug that in, I calculate the future free cash flow of the company, including the terminal value, and then using the discount rate, which I will pump up to 10%, as I do want a higher return, I calculate the present value of that future free cash flow, which gives us an intrinsic value of $97.68, still a lot higher than the current trading price. Now jumping to multiples valuation, we will compare CVS to CI, Singa Group, DVA, and DGX. Now we take these companies' stock prices and divide by their earnings per share to get their PE ratios, which we average out to 20.97 and compare to the PE ratio of CVS to get an average intrinsic value of $119.29, again more than 100% higher than the current trading price of the company. And jumping to our final valuation model, the dividend discount model, we take the dividend payout over the past few years and calculate the average growth rate to be sitting at 6.24%. Now, as I like to be conservative and as the company is currently having some issues, I will project a growth rate of say 2.5%, and we will get an intrinsic value of $140. Now, moving to the ultimate valuation, we take these four models and get an intrinsic value of $112.37, which is more than 100% higher than the current trading price of the company. And even when we plug in a margin of safety of 20%, we still get an acceptable buy price at $90 per share. Now, seeing the intrinsic value of the company being more than 100% over the current trading price of the company might be a little weird, but if we jump back to Google Finance and go to the 5-year graph, we can see that the company has actually been trading at about $108 just 2 years ago in 2022. And if we jump to the max graph, we can see that it has been trading at about the same price in 2015. I hope you have enjoyed this short video. I hope you found it informative, and if you did, make sure to leave a like, subscribe, and let me know down in the comments which company you would like me to evaluate next.